Okay, so you can start doing the first question. You can try. First of all, I'll give the formula. Okay, so I'm writing the formula. Based upon that, you can try, because formula based questions are very simple to do. So ROA, return on assets, is nothing but net income divided by average total assets. So they're asking for year 2. So when you take year 2, you have year 1 and year 2 balances, right? You have year 1 and year 2 balances. Hello.
Yes, sir.
So you can find out the average of this. You can try to find out the average of this. That means how will you find out the average? You
Year
have,
1
see,
plus 2 divided by 2.
opening balance plus closing balance divided by 2, right? Okay. So net income is given to you. This
70,000.
is your net income. Okay. And then you can try to find out the return on assets. And I'm putting the formula of return on equity also here. So you can start doing these two questions. First, you can start this return on equity. So the formula for return on equity is nothing but net income by average total equity. Okay. Start doing this, please. Yeah. I'm waiting.
Return on equity 13.6%.
13.6. Okay. What about return on assets? So I will also simultaneously solve return on equity net income, which is 60,000 divided by average total equity. So how will you find out average total equity? You have to
Yeah,
do assets. Sorry.
75,000 or 60,000.
No, no, no. This is net income.
Year 2 we are finding now, sir.
We have to find year 2 years or 75,000. What about your average total equity? How did you find?
Total equity.
What did you do for equity? So I'll tell, total of assets minus total of liabilities equity, right? Asset minus liabilities capital, na? Equity.
Yes,
Am I right?
yes, yes.
So total of assets minus total of liability you need to do. As you are doing for year 2, you have to do for both the years. Here you will get 3 lakhs in the year 2. And year 1, you will get 2,25,000, right?
Yes,
2,75,000, I think.
75.
Yeah. These two you need to add and divide by 2, and whatever the resultant figure you have to take it here to divide. Fine?
Okay.
Okay. Yeah. I'm just waiting. And total assets need not worry because things are very clear. So hint is given. You can do this. See, direct formula based questions. I'm giving the opportunity.
Yeah. 15.3.
15 point
3.
15.3
75,000 divided by
divided by 3 lakhs plus 75 2,75,000 divided by 2. So 3 lakhs 3 plus 2.75 divided by 2 is 2.875, right? 2
yes.
lakh 87,000. So 3 lakhs plus 2 lakh 75,000 divided by 2 is 2 lakh 87,500. 75,000 divided by 2,87,500. is
26.
26%. Okay, which we have here. Now you can do ROA and tell me fast.
$13.6.
Yeah, 14. Okay. Question number 2. So what is the question? Try to understand. Based on the potential sales of 500 units per year. That means they have that kind of capacity. A new product has estimated traceable cost of, what is traceable cost? Suppose if I'm making a I'm making mobile phone. Okay. For making this mobile phone, can I say the raw material is nothing but the fiber what I use for making this, correct?
Yeah.
So for raw material, I may know what is the cost. So why this raw material cost I will call as traceable cost? Because if I make mobile phone, I will buy this. If I don't make this, will I buy this?
No.
So the cost of this is what is incurred by the organization because of this, right? So
Yeah.
this cost will be called as traceable cost. So I have a manufacturing company and I have 3 divisions: mobile phone division, laptop division, and yeah, I'll just take 2 divisions. This fiber, okay, like what I'm using is for making only mobile phone. So this is traceable cost of mobile phone, right?
Yeah.
I can say this is the direct expense I'm incurring, direct cost. Raw material cost is traceable cost and direct cost. So, like I can also tell there is a mobile technician, a mobile engineer, whom I'm paying a like package of like say some X amount. So this guy, this is also a traceable cost, right? Because the cost here I'm incurring only because of this, correct or wrong?
Yeah. Right.
If that mobile division wouldn't have been there, I wouldn't have appointed this guy. Now, there is a CEO of the company to whom we are paying a package of Y amount. Is this a traceable cost? This is not a traceable cost because if I close mobile division, let's say, even though I need to pay him the Y amount, correct?
Yeah.
This is a common cost for both the divisions, correct or wrong? CEO's package is a common cost for the company. Mobile division or laptop division, he is going to take care of both the divisions, right?
Right.
So that is called non-traceable cost. Common costs are non-traceable costs. Why? Because if this division is there or this division is not there, if this division is there or it is not there, if both the divisions are also not there, but CEO will get his salary or not.
Right.
Let's
Yes.
say for some, yeah, or else let's say if the production, if these 2 divisions are there, no worries. Production is happening here or happening here, not happening in anywhere, whatever it is. Still we pay the package.
Yes.
So these are called common cost. Okay, rent. Rent is also one of the example. Whether you make mobile phones or laptop or you don't make them, you have to incur the rent you have to pay for the premise. So these are called non-traceable costs. So generally common costs are non-traceable costs, right? Traceable costs are because I'm making this, I'm incurring that cost. If I wouldn't have made this, I wouldn't have incurred that cost. Finished.
Yeah.
The cost is existing because of this activity. Okay. So they're asking what is the target price to obtain a 15% margin on sales. Did you understand this question clearly?
No. Again, can you explain profit
They're
margin on?
they're asking, there is a, so they make 500 units per year and a new product has estimated traceable cost of this much. What is the target price to obtain 15% margin on sales? So what they have given is per unit cost. I can estimate, right? So first we'll try to find out the per unit cost. So can you just tell me how much that is? I am dividing this. Tell me how much this is.
1980.
Or else what we'll do is we can have a direct calculation also here. Yeah, 1980 you got, na?
Yeah.
Okay, we will do like this. So 1980 is per unit cost. They're asking what's the target price to obtain. This is cost actually. This is cost. Okay. They're asking what should be the target price. They're asking the selling price. Are you understanding what I'm saying?
Yeah.
So yeah, selling price can only give you a margin. Na? If you sell some particular item for some selling price, then only you can expect a margin. Correct?
Yeah.
To find out the selling price, I have already found out the cost. Now I need to find out the selling price. So it is profit margin on sales. So 100 minus 15, 85. So this is selling price. This is profit. This is cost price. I will take 1980 here. So for this cost price, for this selling price, if this is the cost price, for this cost price, what will be the selling price? So 1980 into 100 by 85. Can you just tell me what's the answer? So when you'll be seeing the answers, this method they are not following. I'm explaining in a detailed manner so that things will be clear to you.
1980 into 100.
Yes.
2329.
Yes, this is the answer. Okay. Have you made note of this? Shall we move forward?
Yeah.
Next question. Okay. So financial analyst who works for company Z has collected the following information on company Z and its three main competitors. Company Z. Okay, so financial analyst is working in this company and he has collected the following information on company Z and there are three competitors as well. Net income, company A, company B, company C, and all these things are given. Based on the collected information, the financial analyst calculated each company's return on assets. Okay. Which one of the following statements is most correct? So for what you need to do now? First, you need to find out the return on assets, right?
Yeah.
So based on the collected information, the financial analyst calculated each company's return on assets. So you calculate each company's return on assets and then you can answer the question based upon these four statements. Will you try this?
Yeah.
Okay, I'm waiting.
No, the option is B.
Option is
B.
B. Yeah. So can you tell me like what is the return on like assets what you've got for each and every this thing?
For Z, I got 0.4,
0.4. Okay.
A 0.5,
0.50. Okay.
0.68,
0.68. This is ROA. Okay.
0.3.
30. So company B's management is operating more efficient than companies is man. Yeah, that's absolutely right. Good. Next question is also on direct calculation, return on assets. You can do this. I'm waiting. ROA you need to calculate.
Zero point two one.
0 point.
21.
Yeah, you have to convert that into percentage because answer is in percentage form.
21.
So what did you do? You took net income divided by
So,
sorry,
950.
because there's no previous year given, right? So the answer is 21%. Next question. So company's year 4 gross profit margin remain unchanged from year 3. So year 3, year 4. So year 4 gross profit margin remain unchanged. That means these two have the same margins. Our company's year 4 net profit margin increased from year 3. Okay. So gross profit of year 3 is equal to gross profit of year 4. But net profit of year 4 is greater than net profit of year 3, right?
Yeah.
Which one of the following would explain the change from year 3 to year 4? Answer. So preferred dividends, it's like a baseless statement. Why? Because we are speaking about net profit and preferred dividends are paid after net profits are calculated, right?
Yeah.
So this is not a
Yeah.
part. Corporate income tax rates decreased. It can be a reason, right? In year 4, if in year 3 my gross profit was $20,000, and year 4 also my gross profit is $20,000. I don't see like any problem, but here after removing all expenses, my net profit is 10,000 year 3, and year 4's net profit margin increased. This is net profit. This is PBT. Okay. Hello.
Yeah.
And sales are 1 lakh. You can say margin means like divide by sales. Net profit by sales into 100 is net profit margin. Let's say here also my profit is 10,000. But what can be a thing here? Tax rates were 30% here. So net of tax it was 7,000. It's 20%. Net of taxes, it is 80,000, 8,000. So this can be a reason, na?
Yeah. Tax rates.
Here my margin is 7%. Here my margin is 8%. Correct? Net profit by sales. Yes.
Yes.
Now next, at this point we can like kind of consider, but let us see. Sales decreased at a slower rate than operating expenses. See, if the sales would decrease, that will change the gross profit, that will change the gross profit figures. But my question is firm about gross profit being equal. So this is a wrong statement, correct?
Yeah.
And cost of goods sold also, if increase decrease, I cannot get the equal gross profits. This is also wrong statement. So only this statement goes well, right?
Right.
Next question. Samrin, like I will confirm you like 12:30 or something. I need to take a pause. I have some work. Again, we can continue in the
Okay.
afternoon. Okay. Hello.
Okay, sir.
Yeah, because I need to go to the hospital to visit, and I have some work that time. Afternoon again, we can take a hour session. Try to cover up some
Okay, sir.
20. Yeah, we will take, but I need some. I have in midway. I have to take some things to hospital. That's all. Okay. So next question. So I
I'll
am
try
trying
for
to
art.
take at least 10 questions right now, 10 to 12. Rest after that coming, we can take one more session here. This question.
Here we have to do any calculations or just by seeing we have
No,
to
we have to read the question for
take.
that. A construction company is preparing to finalize the financial statements for most recent year. Results are sales, cost of sales, administrative expenses. Okay. So sales is given, cost of sales is given. So
Cost of
if you take up sales, 6 lakh 90
right.
and cost of sales 378, and you need to know the gross profit. Just find out the gross profit and tell me. Less administrative expenses 1 lakh 20, and then you have net profit. So you calculate and tell me what that is. Next point, I'm looking what they're saying, correct?
Yeah, 31,1100 gross profit.
31,000. No, no, no. How? 3 lakh 11,100, correct? It's in lakhs, no? Yeah.
Minus
120,800.
administrative expenses.
1 lakh 20,800.
19,300.
Okay. So now let us see what the next statement says. The controller has just found a sales invoice for a job completed on last day of the year. So construction company is preparing to finalize financial statement for the most recent year. Sales results are this. Controller has just found, it seems, an invoice for job completed on last day of the year. The revenue and related costs for the job have not yet been recorded in the accounting system. The job revenues are 95,000 with handling cost of 65,000. So we need to do some kind of modification here, right? So we will increase our sales because revenue, they got revenues, na? So
Yeah.
add
So
95,000 to this. It will become 7 lakh 85,000. Add 65,000 to this. It will become 4 lakh 43,900. Just calculate. Then tell me the gross profit. Administrative expenses won't change. Why it won't change? This is fixed nature expense. Whether increase your activity or decrease your activity, it doesn't matter. These are always fixed. Correct? Hello?
yeah.
See,
Yeah.
rent is the rent going to change if you're like
No,
other,
that's
yeah, that's
not.
what, yeah. Just tell me this, and then also not net profit, you tell me.
34,000, 1100.
3,41,100. Yeah, next. These are in lakhs. You're saying 34,000. Okay. Next.
Okay. 2,20,300.
2,20,300. Now we got all the data. Now let us see what they are saying. What's the impact of this job on year-end profitability? Decrease in company's gross profit margin, increase in net profit margin. I think now you know what to do. You need to find out gross profit margin, that is gross profit by net sales into 100. You need to find net profit margin, net profit by net sales into 100. After finding this, you may get an answer to your questions, correct?
Yeah.
Come on, I'm waiting, you can do this. After this, I'm going to take a test of like 50-50 questions phase wise, okay? In weekdays, I'm going to give those tests.
Here the gross profit margin is 0.43, 40%.
How much? For
0.43
yeah, you have to take for both the years.
for both the years. Okay.
Yeah, because a decrease in company's gross profit margin, increase in net profit margin. So how you will say increase or decrease? By comparing
By
both the
comparing.
years. Yeah, so I will write this as before. I will write this as after. So you need to find out before gross profit margin and after gross profit margin. I'll write it here. Before, after, and I'll write the figures also. Okay. So gross profit margin, net profit margin. Easily we can do a comparison.
Before we have gross profit 47%.
47%.
Now 43%.
I think it was, I'll write it 47%, 43%. Next, net profit margin.
29%, 28%.
Sorry?
29%, 28%.
Yeah, so now you can make a comparison and tell the answer, right? So what are you finding here? Let's say the first one. A decrease in company's gross profit margin, increase in net profit margin. Yes, gross profit margin has decreased. Net profit margin,
Decrease.
this was how much?
29.
Once you can have a like recheck. 1,93,90,300 by 6,90,000 once. It should be 27.
27. Oh, sorry, 27
Yeah,
plus.
that's what I'm saying. So it has increased. Okay, so option number 1 goes well. Understood how to do? Yeah.
Yeah.
Next question. Next question you can do. I'm waiting for this. The first percentage is 12%.
Debt ratio 40%.
Yeah, 40%, yes. So this question may like kind of create an issue. Excuse me, just a second. Yeah. So there is a formula. Return on assets is equal to, since data is of such kind, okay, return on equity into 1 minus debt ratio, right? Hello.
Yes, sir. You
So
gave the formula
return,
in the class.
sorry.
You gave the formula in class, you explained.
Yeah. Yes, yes. So return on equity is how much here? 12%, 0.1
12%.
into 1 minus 0.40 is 0.60. So your answer will be 0.72. That means 7.2%. Okay.
Okay.
Yeah. Next question.
Option D.
Option D. According to DuPont formula. So you know DuPont formula is combination of some two
Mm.
formulas, right?
Yeah.
So which one of the following will not increase a firm's a profitable firm's return on equity? So lowering the equity multiplier would increase profitable firm's return on equity. So what is DuPont formula? So DuPont formula is nothing but sales by average total assets, right?
Yeah.
Into net profit margin. That is net income by sales.
Yes.
So like what is going to happen? Sales going to get cancelled. Net income by average total assets, right?
Yeah.
So this is return. So asset. So return on assets is nothing but asset turnover ratio. So asset turnover ratio, asset turnover, but they are asking return on equity into net profit margin. Okay. So if we want to change this formula, here we can't take equity. Why? Because it is asset turnover. So lowering equity multiplier would increase a firm's profitable firm's return on equity. But why it will happen? According to which one of the following will not increase a profitable firm's like return on equity? Let's say what is this equity multiplier? So actually this I like did you go to this video or like this debt to equity ratio, all these things you did not cover, right?
No.
So leave it this one. Because like I need to explain you what is equity multiplier, debt to equity ratio. So we will do this question after that. You can make a note, question 8 pending. Okay. Hello.
Okay.
Yeah, because you need to
Okay.
learn those concepts as well. Yeah. So next videos when you cover up, you'll get the answer for this. They're asking net profit margin for this question. Can you calculate?
Yeah. Six point six.
16?
6.6.
6.6, correct. 10th question. Asking operating profit margin, operating profit by net sales into 100. You know how to find out operating profit, right? Gross profit
Yeah.
minus operating, administration and selling expenses gives you operating profit. I'm waiting.
$45.
Sorry.
45%.
35%.
45.
45,
In
right?
D.
Good. 45. So what did you do? You have taken
Sales minus
sales,
cost.
cost of sales 60,000 gross profit, then
Yeah. Operating
less
expenses.
operating expenses. So you got 45,000. 45,000 divided by 1 lakh is 45%. Correct. Next. 11th question. I think this is again a repetition. So this we should not do.
Yeah.
Okay, you can do this. No problem. You can do this. Maybe some changes maybe there.
Change.
Hello, hello. Yes.
Yeah. Here
Yeah.
the net profit is declined. In
Here.
last question, the net profit was increased.
Yeah. So corporate rates increase. That's the reason why it will decline, right?
Yeah.
That's the
Oh,
answer. Yeah. Next one. Next one. So a banker is reviewing the bank's current portfolio of outstanding loans and collected the following financial data. on 4 companies that bank has loaned money to. A, B, C, D. This is their EBIT, interest expense. You know, after removing the interest expense, they get earning after interest, right?
Yeah.
So EAT, let's say after tax. We are not saying tax rates here, that's why. On the basis of information provided above, which company has the highest relative likelihood of defaulting on an outstanding loan? Where is the likelihood of default? So if you want to know the likelihood of default, what will you do? There is a formula called interest coverage ratio, right? Have you come across this?
No, sir.
So the formula, I'm just explaining. The formula for interest coverage ratio is EBIT or PBIT by fixed interest charges. I'll tell the meaning of this. This ratio, see, if you want to know a company's capacity, like suppose you want to take bonds of a company, so you want to know the company's capacity to repay its debts. So one of the ratios which will help you to understand about the company's capacity to repay its debts is interest coverage ratio. So let's say the company's like PBIT is 100,000. Why I'm taking PBIT? Because company will pay the interest payments out of operating profits, right? Not net profits. So
Yeah.
operating profit is PBIT. Are you understanding?
Yes.
Because from operating profit, if I remove interest, I get net profit. So operating profit by fixed interest charges is net 10,000. So how much is the capacity of the company to make this payment? 10 times, correct?
Then.
So who has the maximum capacity? Very good. Less default chances. Who has the least capacity? Highest default chances, right or wrong?
Yeah.
See, if this company is having 10 times capacity to pay, another company had just 2 times capacity to pay. So which one has more chance of default? This, correct?
Yeah.
So
Yes.
same thing is applicable in this question. Now you need to find out that one. So this is given, this is given. So what you can do, either you can divide this with this interest expense by EBIT, and you can understand how much is your interest expense in EBIT, how much percent. The highest percentage of interest expense in EBIT will show that they have to pay very high interest, right? So they have the more chance
Yeah.
of default, correct?
Okay.
Yeah, please do this. So high interest expense is more chance of default, right?
Yeah.
Just a second, Samre. You
Some.
can, yeah.
Okay.
Sorry, 2 minutes, 2 minutes. Yeah, yeah.
Okay. That.
Hello. Yes, Amrin, tell me.
Company A and B 0.79, 0.72, almost losing
Zero.
everything.
Just a second. No, we were doing which question? 12th, na? Oh, okay,
12th
okay.
one.
Yeah, understood. Actually, got a call now. So, yeah. So, which one has the, like this thing, highest relative likelihood of defaulting? This one, right?
Both company A and B, yeah, almost A.
Yeah,
Yeah,
75%, 79% something, right? Yeah.
79, yeah.
So, like 13th one, like, can you give me a second? Like, I'm just on a call, and like with that, I'll resolve it, like whether I'm going or not, right now.
Okay,
So then like just 2 minutes call, then we can continue with 13, 14, 15, or else if time permits, I'll finish all 20 questions and go. Okay.
okay.
Why to interrupt? Just give me 2 minutes time. I'm just calling someone. Yeah.
Okay.
Yeah. Yeah.